This is not just another refinancing story. Rockwell Land's 10 billion pesos bond issuance marks a bold new chapter, a decisive move into higher leverage, shaped by ambition and a much larger commercial footprint. After the 21.6 billion pesos acquisition of a controlling stake in Alabang Commercial Corporation, Rockwell's retail and office portfolio expands by nearly 60%. The strategic logic is clear: more space, more opportunity. But the future depends on how quickly this expanded platform can generate new earnings, because leverage creates both promise and pressure. Let's break down the numbers. As of September 2025, Rockwell holds 33.84 billion pesos in interest-bearing debt against 38.60 billion pesos in equity. The reported debt-to-equity ratio is 0.88x, conservative by regional standards. But add the fresh 10 billion pesos in bonds, a mix of 3- and 5-year offerings, and gross debt rises to the mid-40 billion range. This isn't crisis-level borrowing, yet it signals a shift from Rockwell's traditionally cautious balance sheet to something more assertive. Cash reserves stand at just under 4 billion pesos, and elevated interest expenses are now a reality. Operationally, Rockwell is not in trouble. The first 9 months of 2025 delivered consolidated revenues nearing 15 billion pesos, EBITDA over 6.5 billion pesos, and net income at 3.5 billion pesos. Management highlights a strong EBITDA margin and improved interest coverage, emphasizing that the new funds will drive capital expenditures across key projects, from Power Plant Mall Angeles and Rockwell at IPI Center to Aruga Hotel Macdon and Rockwell Center Bacolod. So, the company isn't borrowing to survive, it's borrowing to build. Yet, leverage is leverage. Estimated annual interest from the new bonds will add over $500 million pesos to Rockwell's financing costs, pushing total annual interest expense significantly higher. Unless EBITDA growth keeps pace, interest coverage will tighten. The company can carry the debt, but only if earnings rise fast enough to match the new burden. This brings us to Alabang Town Center. Rockwell's long-sought scale and recurring income commercial assets is finally within reach, especially in a premium southern corridor. Their reputation for premium retail spaces, most notably the Power Plant Mall, suggests they can enhance tenant mix, improve rental yields, and unlock redevelopment value. If ATC matures into a consistent annuity-like asset, it could underpin Rockwell's new capital structure. Commercial assets are often a stabilizing force, especially when residential cycles soften. But the market is less forgiving these days. Oversupply in mid-market condominiums persists, and while Rockwell targets high-end segments and claims relative immunity, slower property environments affect everyone. Higher leverage means greater sensitivity to absorption rates, redevelopment timelines, rental ramp-up, and execution risks. Premium positioning offers protection, not invincibility. The question is no longer whether Rockwell can raise funds. The market validated that with the PRS AA/stable rating and full subscription. The real issue is how quickly commercial revenues will accelerate, whether the interest expense begins to outpace operating income, and if Rockwell will tap more of its remaining 20 billion pesos shelf before new assets start producing stronger cash flow. There's a credible bull thesis. Long-dated funding is prudent, and the expansion into commercial real estate is timely. If ATC's promise materializes, locking in 5-year money now could prove shrewd, turning today's leverage into tomorrow's advantage. Yet, the bear case is clear. If the commercial pipeline lags, residential demand stays patchy, and financing costs remain high, Rockwell could spend several years juggling a heavier interest burden with slow earnings growth. That would not break the company, but it would compress financial flexibility, diminishing the balance sheet resilience investors have come to expect. In the end, Rockwell's story is evolving. The debt is manageable, the strategy is logical, and ATC may transform the company's commercial prospects. But now, the burden of proof is higher. Rockwell must grow fast enough and with robust recurring earnings to cover the extra annual interest it has taken on. In today's property market, the challenge is real and pressing. It's not an impossible task. It's simply the new game. For investors and analysts, three indicators will matter in coming quarters. Watch for accelerating commercial revenues, the pace of rising interest expense, and Rockwell's appetite for further bond issuance. Because more than ever, performance, not just funding, will define Rockwell Land's next chapter.